Welcome, friends. In this edition of live virtual classes, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. Now, as students, we are in this series. Basically, it is a hybrid mode. We are uh, basically conducting the revision classes because we hope that you must have gone through the recorded lectures. So after going through the recorded lectures, now in this session, we shall take up your queries as well as our faculty, CA Divas Gupta sir, will take some revision, will discuss, will revise the same topic. So earlier we were discussing the topic of derivative analysis and valuation. So in today's class, Divas sir will revise a balanced topic, and after that, a topic there is a real option that I will take up in the end. Okay, and after that, of course, we have MCQs for you to test your knowledge. So, student, with this, now I hand over the class to CA Divas Gupta sir. Divas sir, now please start the class.
Sure,
Thank you.
sir. Thanks a lot, sir, for the opening remarks. Good morning, students. Good morning, everyone. So till now in derivative students, we have discussed about the types of derivatives, that is forwards, futures, and options. What are the common features of the derivatives? Then how do we do the valuation of forwards and futures? That also we discussed. And then for options, we started with the valuation options on valuation methods for binomial method and risk neutral method. So till here we have completed our discussion over in our previous session. In today's session, we will be continuing the discussion on the options valuation using the Black-Scholes model, and also we will cover up the put call parity theory. Then we will move to the other aspects. So students, before we move to the Black-Scholes model and put call parity theory, I would want to discuss 4 different types of cases with all of you as regards options are concerned. Okay. So let's say in case 1, we take an example of buying a call option. Can we also say that it's a long call option? Yes, because taking a long position is equal to buying the instrument. Now, in this case, we are buying a call option. That means we are purchasing a right to buy. Understood? Now, if we are purchasing a right to buy during settlement, once the maturity of this option comes, I have to pay the strike price equivalent price to the option writer so that I can purchase that. For a moment, let's assume that the settlement is happening on gross. Okay. For a moment, let's assume that the settlement is happening on gross basis, not on net basis. So what I will do, because I have to pay strike price as on the maturity date to exercise my right to buy, I have to invest the present value of that strike price today, right? Then only I will be able to make it up on the date when the option expires. Correct? So step 1, step 2, and then step 3. Actually, step 2 is just an elaboration of step 1. Why are we reading these steps? Just to see how the flow goes and how the strategy should be. And then we will make use of this strategy in put call parity theory and Black-Scholes model both. Okay. So this was it on the case 1. Now let's come to case 2. Case 2, let's start with the example where we are selling the call option or we are writing the call option. In the first case, we were the holder of that call option. In the second case, we are the writer of that call option, this one. So the moment we do a short of call option, that means we are selling the right to buy. We are selling the right to buy. The moment we are selling the right to buy, that means tomorrow if the option gets exercised, then we have to deliver shares because I've sold the right to buy to someone. And if he or she exercises that right, I am bound to deliver the shares. So what I will do, I will purchase shares today. This is my step 3. Clear? Whenever I will short a call option, I should purchase one share today so that I can balance out certain risks on account of the price movements. And it seems more logical also because tomorrow, if the option gets exercised, I can settle it through the share purchase today. Clear, students? Now, the third case. In the third case, we are purchasing a put option, or we can say it's a long put option. Now, purchasing a put option means purchasing a right to sell. If we're purchasing a right to sell, that means tomorrow, if I'm exercising this option, I have to sell something. Something what? That underlying is that share. So I will purchase that share today and keep it so that I can settle it using the shares once the expiry comes. Clear? And the fourth case, which is again the short of put option. Just a second. Yes. So the fourth case is we are selling a put option. The moment we are selling the right to sell, that means we have to purchase the share. Correct? Once the option gets exercised, we have to purchase the share. Since we have to purchase the share, hence we have to invest the present value of strike price today. Clear, students? I hope we can clearly make out if in the options segment we are doing one step. So how and what we should do in the other segment. Clearly linked is there. Now, so these are the four different types of cases. Okay. Case 1, 2, 3, 4. We will make use of these cases. Now, students, with our previous discussion, all of us are aware that options can have three situations, right? One is in the money, second is, sorry, at the money, and third is out of the money. Now, suppose there is an option which is out of the money. Do you think someone will try to purchase that option? Or let's say, will there be a premium for that option? Already it is out of the money. Abrikesh,
Uh, Deva sir, is there any problem?
yes, yes, sir. Actually, my screen stopped working. Just a second.
Okay, sir.
So meanwhile, Abrikesh is asking at what stage we have to exercise. Example in case of short put option. Okay, I'll answer that question, Abrikesh. Just give me a second. Okay, there is some issue with the application. I'm just restarting it. But till then, so Abrikesh, see, as we discussed in our previous session, there are two types of options, right? One is the European option and second one is the American option. And one of them gives us the exercise option on the expiry date, and the American option give us the option of exercising it anytime up to the expiry date. Correct. So it is up to us and depending on the product that when we want to exercise. And definitely I will exercise it once the spot price has moved below the strike price in case of a put option. Correct. That is what I'm trying to say. In case the option is at the money, out of the money, or in the money. Okay. We have to decide accordingly. Just a second. Okay, student. Abrikesh, I hope your query is resolved. So it really depends on the type of that option. Okay. Yes, perfect, Abrikesh. Thank you. Now, as I was asking that, in case the option is out of the money, do you think that any investor would want to pay for that out of the money option? No, right? Because already it is not fetching any result. Correct. For example, in case of a call option, the spot price is lesser than the strike price. And similarly, in case of the put option, the spot price will be higher than the strike price. Then it will be out of the money. That we have discussed in our previous session, students, right? Now, let's come to the defining part of options premium. So what we say is options premium is always reflective of the extent to which it is in the money, students. Please focus on this word in the money, adjusted for the time value of money. Simple. So if you think from the perspective of option buyer, how much I will be able to pay to the option seller? It will really depend on what that instrument is giving in terms of in the money. That I will take it at a time that I will take it at a present value factor. Okay. So value of a call or put option is really in the money payoff adjusted for the time value. Hence, it is called as present value of in the money payoffs. This is the broad concept, students, on the option valuation. And on this premise, Black-Scholes model is based out of. Let me come to the option pricing. Yes. Now let's discuss about the Black-Scholes model. Okay. In this Black-Scholes model, students, I am using case number 2. Out of those 4 cases that we discussed, right? Case number 2 was we are selling the right to buy, which is we are writing the call option. Okay. And in this case, if we are selling the right to buy, that means tomorrow, if the option gets exercised, I have to purchase the shares, right? Because I have sold the right to buy. Hence, sorry, if I'm selling the right to buy, then I have to sell the shares, right, on the expiry. Hence, I have to purchase the share and keep it today. Okay. So let's take an example of Mr. X, for example. He purchases the share and I'm denoting this situation by A, and he sells the right to buy. I'm denoting the situation by B. In that case, what will be the cash outflow that will happen today? Cash outflow that will happen today is the share price value, which is 100 rupees, for example. Okay. And in case I'm selling the right to buy, I'm writing the call option. The cash inflow will be what? The cash inflow will be the strike price, right? I'm sorry, because I will be able to realize 90 rupees as the strike price equivalent value once I sell it. So what do you feel, students? What should be the premium here? The premium here should be the cash outflow today minus the 90 rupees, which is the realization that I will get. In this case, this is out of the money. This is losing because I will lose 10 rupees. So this is out of the money example, but I'm just telling you conceptually what I will purchase is my cash outflow. What I will get in the form of writing that call option at B will be my cash inflow. The difference is what I will expect as a premium. Okay. Now let's elaborate it further. Students, we understood A minus B is equal to premium of call option. I think all of you will agree. A is what? Purchase of share. B is writing the call option. Correct? Now, tell me one thing. As per the regular principle, if A is the cash outflow today, right? And B is the cash inflow after 3 months, are these two numbers comparable? No, because they have time value of money embedded in that. Hence, what we will do, A we will take as it is, and B we will take present value of B, which is essentially the today's value of what I am supposed to get after 3 months. Correct? So this much variation is okay. I think, and hence our formula of A minus B equal to, hello?
दिवस जी गुड मॉर्निंग.
Yes, sir. Good morning, sir. Good morning.
अबर केस मांकड़, you are very lucky that you are having one-to-one training. You are the only student in the class. आशीष जी, हमें ड्रास्टिकली पॉपुलराइजेशन करना पड़ेगा
Yes, sir.
एलवीसी को.
Yes, sir, sir. We
नहीं,
are working on that,
देखो
sir.
आप कितनी शर्मिंदगी की बात है कि केवल एक स्टूडेंट है, हम 40,000 खर्च कर रहे हैं.
Yes, sir. Yes, sir.
दिवस जी इतनी मेहनत से पढ़ाते हैं.
सर करते हैं सर.
नहीं, मैं बार बार रिक्वेस्ट करता हूँ कि आप पूरे फ्लायर, क्या सब्जेक्ट पढ़ाएंगे, क्या
सर.
टाइमिंग है, कौन
हाँ सर.
फैकल्टी है. दिवस जी इतना, हेड्स ऑफ टू यू. मतलब आप इतना सिंप्लिसिटी से पढ़ाते हो.
सर वी आर वर्किंग ऑन दैट. अभी कर देते हैं सर वो.
क्या वर्किंग? 3 महीने से हर रोज फॉलो कर रहा हूँ आशीष जी, एंड यू आर सेइंग यू आर वर्किंग.
ठीक.
अगर मैं न्यूयॉर्क से क्लास अटेंड कर सकता हूँ,
सर दैट्स
प्लीज जरा देखिए.
हैट्स ऑफ टू यू सर. आप अपना इस टाइम तो वहां पर रात हो रही होगी सर.
हाँ, रात है, मतलब
हाँ,
फिर भी मैं
मैं वही सर.
रात के 10 बजे.
हाँ सर. सर आप तो बोर्ड के लिए बहुत मेहनत कर रहे हैं. एंड वी मतलब वी
नहीं,
आर.
लेकिन आप लोग का सपोर्ट नहीं मिल रहा है,
नहीं
देखो
सर, बिल्कुल मिलेगा
आशीष जी.
सर.
नहीं, लेकिन कब मिलेगा? 4 महीने हो गए. 12 जून को बोर्ड के 4 महीने कंप्लीट हो जाएंगे सर.
ठीक है सर.
मैं बोल रहा हूँ 10-10 मॉडल पेपर बनाओ.
सर.
दिवस जी से मेरी कल सुबह बात हुई. दिवस जी, मैंने न्यूयॉर्क से आपसे बात की,
हम्म.
Sir. हाँ जी.
तो आप बोले मेरे हैंड रिटन नोट्स है. अरे, इतने बाजार में कोई टाइप करवा सकता है. आशीष जी को हैंड रिटन दे दो, वो टाइप करवा देंगे.
ओके सर.
लेकिन
ओके सर.
अगर वर्ड में डॉक्यूमेंट नहीं होगा तो कैसे उसको प्रोसेस करेंगे, कैसे उसको इम्प्रूव करेंगे?
ओके सर. ओके सर, वी गेट देम टाइप सर. वट एवर द असिस्टेंस वी.
नहीं, लेकिन मेरा इंटरवेंशन लगता है जब मैं लिखता हूँ ग्रुप में कि व्हाट बीओएस फैकल्टीज आर डूइंग टू
सर.
फॉलो अप विथ एलवीसी मॉडल पेपर्स. मैं बोल रहा हूँ 10-10 मॉडल पेपर बनाओ, क्वेश्चन बैंक बनाओ, उसका बुकलेट बनाओ. मैं कह रहा हूँ 100% मुझे रिजल्ट लाना है. एवरी सीए स्टूडेंट मस्ट पास.
Certainly sir.
थैंक यू.
Thank you sir. Thank you sir. Yes sir, good night sir.
So yes, friends, on this part, as we were saying, A minus present value of B will give us the premium of call option. Then premium of call option, we can again further deep dive it, saying, now what is A? A is the share price today. So can I write it as spot price? And B is what the present value of B that we discussed. But in this case, students, we are assuming that the ratio is 1:1. Okay. How? Because we are saying that for one call option return, we are purchasing a one share. Okay. But which is not practically true, because as we understood about the hedge ratio, I think in some of the previous discussion we would have discussed it, and today also we will be discussing it in detail. So what is hedge ratio? Hedge ratio is how much number of options will be needed to hedge one share, or vice versa. And even in case of futures or forwards also, how much futures or forwards are required to hedge one share. It can be vice versa, right? So it establishes the link between how much options and how much shares. Okay. So that they are perfectly hedged. It is not necessary that for one share, you have to sell one option. It's not necessary. Okay. Hence, 1:1 is something that we have assumed wrong, because we are saying A minus present value of B. Now let's evaluate it further. Hedge ratio is equal to 0.5. For example, I'm taking an example of 0.5. So that means you have to purchase 0.5 shares for one option to arrive at a complete hedge. That is the real meaning of hedge ratio. So hedge ratio will give us how many shares to be purchased so as to write one call option. And this is true even if we are writing a put option also, right? So for put option also, there is a hedge ratio that will be there. Okay. So we have to include the hedge ratio concept within the premium. Okay. We have to include the hedge ratio concept within the premium. So can I rewrite the above as spot price into hedge ratio minus present value of strike price, students? Correct? I think all of you will agree, because here we have corrected our assumption of 1:1 and we have multiplied with the hedge ratio, students. Okay. So the premium of call option is equal to spot price multiplied by hedge ratio minus present value of the strike price. Now here, the assumption that option will be exercised or not. Now the question from Abrikesh comes, right? You have asked that what is the, I mean, in what situation, let's say, the option will be exercised? Because till now, students, if you see, we are only concerned with that this is my spot price multiplied by hedge ratio, how many shares to be purchased minus present value of strike price. Till now, we are not taking into account the probability to exercise that option, because it might happen that the option will get out of the money later, and hence it will not remain exercisable. Okay. And hence the probability that call option will be exercised will also have to be taken into account. In case that probability is 0, students, in case that probability is 0, then what will happen, students? Then the option will become out of the money and the premium will become 0 or negative, right? But for market, premium is 0 or negative. That means nothing will get traded. So see, students, premium of call option. Now this is the final formula that we have derived. Okay, this is our entire discussion. So spot price multiplied by hedge ratio, this will give us how many shares to be purchased today, minus present value of strike price for that one call option, multiplied by the probability that spot price on expiry is higher than the strike price. That means the option will get exercised. What is the probability? Because this is a call option and call option will get exercised once the price on expiry is higher than the strike price, students. Correct? So till here, I hope all of you are there with me, students. I think Munish is there from the Munish Kumar Gupta. You are also there from the other side. So then premium. Now let's translate this equation into what has been mentioned as per the formula, students. So premium is equal to spot price multiplied by ND1, which is the hedge ratio, students. So this is multiplication factor actually. I'm just removing it. Otherwise, it will get confused with this X. So S multiplied by ND1, which is the hedge ratio, minus X e raised to the power minus RT. So e raised to the power minus RT means that we are taking the present value factor. Basis the continuous compounding, students. Wherever we use E, that means we are using the continuous compounding. So e raised to the power minus RT will bring this X to the correct value. So the present value of strike price becomes XE raised to the power minus RT multiplied by ND2. Now ND2 is the probability that spot price will be higher than the strike price, students. Clear, students? So x raised to the power minus x into e raised to the power minus rt can be rewritten as x divided by e raised to the power rt. That we can do, yes. Now with this, we are bringing everything to the present value. Okay, students. Now let's move ahead. Here we discussed S is equal to spot price, X is equal to strike price. Now, if you see, students, this hedge ratio and this probability, while we understood in layman's form ND1 and ND2, but mathematically what it represents? So mathematically it represents normal distribution value for D1. And this is cumulative left to right. And ND2 is actually the normal distribution value for D2. Again, this is cumulative from left to right. Now, what is D1 and D2? So D1 is, and there is a complete formula. This is derived by Black-Scholes model with lot of iteration. So D1 is equal to natural log of S by X plus R bracket R plus volatility square divided by 2 multiplied by T divided by volatility underscore T. And D2 is relatively simpler, which is D1 minus V underscore T. Here, R is equal to risk-free rate of return, T is equal to time to expire, V is equal to volatility, which we also call as standard deviation of returns. Or V square is also called as variance here, right? We are using V square, that is called as variance. And lastly, spot price, and lastly, exercise price. So natural log will become, so natural log, all we know that is denoted by this, right? A by B, here we are doing S by X. So for solving natural log, most of the time, indication will be given in question. Let's say through some extra information, and even the normal distribution value will also be given in the question. But remember, students, we always need to take from left to right, the cumulative number. So this is pure mathematical numbers, right? And we discussed here that natural log is actually reverse of the exponential function. So natural log is reverse of E. So E raised to the power A is equal to B, for example, we discussed here, right? So natural log is always having a base of E. So natural log of B will be equal to A. Understood? So this will give us the power of E. How much power E will be exponentially taken. Okay. Now, there is some logical discussion, students, we can base on this formula. For example, if call option, let's take an example of call option. D1 is comprised of natural log of S by X. If spot price increases compared to the strike price, students, for a call option, that will mean higher D1, correct? Because natural log will increase, it will lead to higher D1. It will lead to higher ND1 also. And hence it will lead to higher premium, which is whatever correlation is, right? So here what we discuss, students, we are trying to see the impact of different factors on the premium. Okay. Higher spot price compared to the strike price will lead to higher premium. And the reasoning is this. Similarly, let's say there is a higher volatility. Tell me, students, if there is a higher risk, I will expect higher premium. Correct? Higher risk means higher premium because the reward will also be higher. So if volatility is higher, this also will become higher, D1 will become higher, ND1 will become higher, and hence premium will also become higher, students. Clear? Now, there is a concept of this normal distribution, standard normal distribution, students. This we have discussed in detail in our previous sessions. I will just touch upon this briefly. So this is represented by a curve, which is presented here in front of the screen. So this is a distribution table which distributes equally. Let's say in the middle of the distribution table lies this. So towards the left also, towards the right also, it will be 0.5 and 0.5. And this represents the area under this curve represents the probability, students. And you remember, always we have to take from left to right. Abhikesh, this is not binomial normal distribution. Binomial is other method that we discussed that has a tree concept, that has a concept of two outcomes. This has, as a concept, has a normal distribution, which says that it's a separate concept. It says that if you convert any series to a standard normal distribution, and how will you convert that? We will come to that later. If you convert any series of data to a standard normal distribution table, then this will look like this. And you can try to find out that what is the probability of the next observation. Let's say I have a series of 100 data points. I have to find out that what is the probability that the 101th data point will be some number. So this outcome will be given by this normal distribution. Okay. Perfect. So as I said that we have to convert everything to the standard normal distribution that we use, that we convert using the Z-score. Now what is Z-score doing here? Z-score is actually making your mean 0 and standard deviation as 1. For every observation, minus mean divided by standard deviation. So for whatever that observation, that mean is, which is for example 10. What is happening? Discuss again.
I think there's some issue in your tab today.
Correct, sir. Actually, what has happened now? This Zoom application got updated.
Okay. Today I have faced the same problem in the morning.
Okay, sir. Okay.
Took a long time for opening the Zoom application.
Got it, sir. Got it. They would have released some update actually.
Yeah, I think same here. Okay. Please, no problem. Please continue.
Sure, sir. Sure, sir. Yes. So what I was saying is that Z-score will make the mean as 0 and standard deviation as 1. That is why this formula, if you see, it represents that only. And hence, once that is arrived, we will come to a Z-score. Using that Z-score, we can put that Z-score in the standard normal distribution table and arrive at the probability, students. So if Z-score is 2.66 in this case, right? So the probability of having 18, the cumulative probability of having 18 is 99.609 for a series of data which has a standard deviation of 3 and mean of 10. Okay. See, don't get confused. What I'm trying to say is that the quotient will indicate you what value has to be used. Simple. Okay, it will be given. And just remember one thing, we have to only use the cumulative area. Quotient might confuse you that this is like, for example, here, the quotient might give you this data, right? Let's say it might give you from right to left. And we have to only use left to right. So what we can do, 1 minus this data will give us left to right. Because as I said that area under this curve, okay, what is the total of probability? It is always 1. And the area under curve represents probability. And hence it is always 1. Okay. So we can easily calculate the missing values if the left to right cumulative score is not given to us. Okay. See here, I had given example also. So till 18, till reach 18. So 0.7 is actually the left to right score and 0.3 is right to left score. Okay. We say sometimes it says as one tail to cumulative. So let's say we have to convert. Sometimes the question might say one tail. So what is the meaning of one tail? One tail is so for example, this is the bifurcation. Here mean is actually 0. Okay. By using that Z score, mean becomes 0. So one tail means if our value is here, so from right, or let's say if our value was here, so from here. So this is one tail. Okay. Now, interestingly, if we have to find out for 18, so if one tail is 0.3, so cumulative will become 0.70. Okay. And for example, here it is some other value. Let's say 2. Okay. Then still this will be, this one tail will be okay. You're getting my point because it is already left to right. Okay. And similarly, two tail is actually one tail multiplied by 2 simply. So we have to first divide by 2 and then take a 1 minus 4. So this is what we discussed. Mean as 0, standard deviation as 1. There is one more important fact about this standard normal distribution table is 99.7% observations falls in between these two range, which is mean minus 3 times of standard deviation, and here it is mean plus 3 times of standard deviation. Clear? I think with this, let's try and attempt this question, students. Okay, so this will cover up our concept on Black-Scholes model, which is very, very important, students. Okay. So just a second, I think there is some question on the chat box. No, I think that's okay. So from the following data for certain stock, find the value of call option. Price of stock now 80 rupees, which is the spot price, students. Exercise price is 75. Standard deviation of continuously compounded annual return is 0.4, which is the volatility. Maturity period, which is T is equal to 6 months. Annual interest rate is 12%. And see, students, how the language has been used, number of standard deviation from mean, which is already Z score. Correct? And here they are saying area to the left or right. This is one tail area. Okay, this is one tail area. So we have to convert it to the cumulative area. They have also given us the e raised to the power and natural log of something. So let's first of all start, students. Value of call option using Black-Scholes model. So we will have spot price multiplied by ND1 minus present value of strike price multiplied by ND2. Let's first calculate D1 and D2. So D1 is what? D1 is actually natural log of S by X, students, right? Plus this entire formula, whatever it is. So let's calculate the natural log of S by X, which is 80 by 75. 80 by 75. Now this becomes how much? Natural log of 1.0667. So this becomes 0.0646, students. So natural log is clear. Now let's put other values for calculating D1. We had R, which is annual interest rate, 0.12 plus 0.40 raised to the power 2 divided by 2 multiplied by 6 by 12. So students, please note that this is an annual number. R should be annual number because time we are multiplying later on. Okay, so don't take already a 6% here. Take 12%, which is for the full year. So accordingly, D is 0.5820 students. If D1 is 0.5820, D2 can also be calculated using this equation as 0.2992. We have calculated D1 and D2. Now we have to calculate the ND1 and ND2. So 0.5820 and 0.2992. We have to see what values we have been given in the question, students. So from 0.25 to 0.30, can we calculate, first of all, from one tail to cumulative? The answer is yes, we can do. Similarly, here also from one tail to cumulative, the answer is yes. These one tail were given in the question, students. Now our value lies 0.5820 in between these two values. We have to use interpolation technique, students. So using interpolation technique, we try to calculate what is the higher level value, what is the upper level value. Sorry, what is the upper level value, what is the lower level value. And the difference between them, we take and adjust it to the basic value, the lower level value, to arrive at the middle value. Okay. So this becomes 71.97. So what does this mean, students? For writing one call option, you need to purchase 0.7197 shares. Clear? There is a probability of 61.76% that the option will get exercised because the strike price will be higher. Sorry, because the spot price will be higher than the strike price, students. So we'll just put it in the call option valuation model, right? And last information that we will make use from the quotient is e raised to the power 0.12 into 0.5, which is from here. Okay, students. As you can see, if let's say the flow of the question is very simple, it's just simply you have to make use of the formula, put numbers in this, do the calculation and arrive at the valuation. Simple. Yeah. Now, students, I will just quickly use the discussion that we did in call option for valuation using the Black-Scholes model. We will just replicate it for the put option and close it quickly. For doing this, students, we will make use of the case 4 out of the 4 cases that we have studied. Now, case 4, students, we said that we will sell the put option. We are selling the right to sell. Okay, we are selling the right to sell. So what will be my cash outflow? The cash outflow is equivalent to the strike price, right? Because if I'm selling the right to sell, I have to purchase the share. I have to purchase the underlying after the expiry, correct? Because let's say that person exercises the right to sell, then that person will sell the underlying to me. I will purchase that underlying. So hence the cash outflow will happen to the extent of the strike price. And what I will do, I will sell equity in the spot market to realize the cash inflow at spot price, students. Correct? How it will happen? See, this is a detailed one. Borrow one equity share, which is because see in the entire hedging, we say that we neither have funds, we neither have equity shares. So even if we have to sell the equity share, we have to borrow that equity share, right? So let's say borrow one asset, which is equity share, short sell that equity share. We will get the present value of strike price equivalent from this. And on expiry, this investment of the present value of strike price will get redeemed. Okay. Once it gets redeemed, I will purchase one share back using the option that I have written, and I will return that share back to the person from whom I borrowed. Simple. So this strategy is clear. So the B part is actually I will short sell the equity share in the spot market to realize the funds. Okay. Abrikesh is saying because the example is for one share. Yes, Abrikesh, in this also hedge ratio will come now. Okay. As of now, for simplicity, I have taken 1:1. Now, let's come to the valuation of the put option. In this case now, as I said that here, this minus this will be my premium, right? Cash outflow minus cash inflow. So cash outflow is what, students? Present value of the strike price that I have to pay. N minus D2 becomes what? N minus D2 becomes the probability that the price will be lower than the strike price, and hence the option will get exercised, students. And then minus spot multiplied by N minus D1. So N minus D1 is the hedge ratio for put option. Minus N minus D1. This is the hedge ratio of put option, students. So if ND2, students, was the probability that the price is higher, N minus D2 will become the probability that the price will be lower. Simple, right? Okay, students. So that's all. So N minus D2 will be what? N minus D2 will become the Z score. So minus D2 will become the Z score for which we will calculate the standard normal distribution value, students. Okay. So with this, we cover up the Black-Scholes model for both valuation of call option and put option, students. We have covered one question on valuation of call option. In our assignment, there was another question which had valuation of call option, valuation of put option, and I think put call parity theory also. Perfect. So till now, students, derivative, we have discussed forwards, futures, options. We have discussed their concepts. We have discussed how they are used in hedging. And we have discussed on valuations. On valuations, we discussed about forward and futures using the compounding, continuous compounding, annual compounding, present value, future value. Options, we have discussed about three. One is binomial method, second is risk neutral method, and third one is the Black-Scholes method for both call option and put option. Now comes very, very important theory, which is the put call parity theory, students. Okay. Now, this theory is actually based on the options put call, put option, and call option. Okay. In this, students, we are making use of case 1 and case 3, students. Okay. The out of the 4 cases, case 2 and case 4 are already discussed. Now, case 1 and case 3 is what we will be using. So let's say time is 1 year. And this we are talking about call option and put option both. R is equal to 20%. Strike price for call option is 180. Spot price is 150. Okay. And if we also say that the premium of put option is 10 and premium of call option is 15. So let's take all these data points and compare case 1 and case 3. Okay, students. So for example, for case 1, Sorry, here this is case 3 of what we discussed. In case 3, we were purchasing a put option. Perfect. The moment we purchase a put option, that means we are purchasing a right to sell. Now, tomorrow, if that right to sell needs to be exercised, then I have to sell that share. The moment I will sell that share, I will realize the strike price, right? Now, what will be my initial cash flow, students? Initial cash flow will be, once I purchase a put option, I will end up paying the premium. Okay, I will end up paying the premium, students. Then, second thing, I will also purchase the asset today, because the moment I exercise the option, the right to sell, I have to sell that asset. So for selling that asset, I will purchase the asset today. At what price I will be able to purchase? 150. Clear? So my total cash outflow becomes minus 160. Okay. So this is investor 1, who is the put option holder. Now let's talk about case number 3, students. Sorry, case number 1. Case number 1, we said that we will be purchasing a call option. That means we are purchasing the right to buy. And that purchase will happen at 15 rupees, right? Because the value of this call option is 15 here. Sorry. So that 15 rupees, we will purchase the call option. And on the exercise, we have to pay the strike price equivalent to purchase that call option. So what we will do for this 180, which is the strike price, we will invest the present value today, which is 150. Sorry. Correct? 20% is the rate of return. So I will have to present value 180 to 150. Clear? So the second investor is the call option holder, whose cash outflow is 165. Okay. So two portfolios are formed. Now, let's say what happens after 1 year, students. For investor 1, so we will take 3 different scenarios, A, B, and okay, we have taken only 2 scenarios, sorry. One is higher one and one is lower one. Okay, that will be good enough. So let's say the actual price comes at 200 on expiry, students. Okay. Yeah. So this actual price comes as 200 on the expiry. So what will happen to investor 1? Investor 1 is holding a put option. Okay. Now what he will think? Strike price is 180, market price is 200. It is already out of the money because I can go and sell it in the market. I will not be exercising my option at 180. So what we will say, put option has become out of the money and hence the value is nil. The shares will be sold at 200 and the sales proceed will be realized at plus 200. Because he was holding the share also, right? So he will sell the share at 200. So the cash inflow will be 200. Correct? Here we said, right, that 150 he will use the amount for purchasing a share. So that he will sell here. Now investor 2 has taken a call option. Call option with a strike price of 180. Market price is 200. So it is in the money. Correct? And the payoff is 20. I will get 20 rupees because of the call option. This is what we are getting, students. Then this 150 rupees that has been invested, the investor will realize this at the rate of 20%, students. And hence the investor will realize 180 from here. So the total cash flow for investor 2 is also 200. This is 200. and investor 1 is also 200 students. So what we are concluding here, same price of 200 is giving us this. Okay, one price of 200 is giving us the similar value for investor 1 and investor 2 students. Now let us come to second case, wherein we are saying that the price comes down to 100. The moment it happens, students, for investor 1, put option becomes in the money. 180 minus 100, 80 rupees will be the payoff. And the shares that he is holding, he or she will sell it at 100 rupees. So the overall cash flow will be 180 students for investor 1. Now let's come to investor 2. Investor 2 is holding at a strike price of, investor 2 is holding a call option with the strike price of 180. The market price is 100. It has become out of the money. So the investor will not realize anything out of this. And that 150 rupees that investor 2 has invested, they will realize that 180 students. So the net cash inflow after 1 year will become 180. Okay. Now here also students, what we observe that this is also 180 and this is also 180. Investor 1 and 2 are both are having 180. So can we conclude that whatever prices occur in the market subsequently, the realization of investor 1 is equal to realization of investor 2? That is for sure. I hope all of you will agree with me, students. And hence, if anything has a similar cash inflow after 1 year, don't you think today also they should have a similar cash outflow? The market forces will act in such a manner that they will adjust their current outflow prices in such a manner that it will get equal. So investor 1 initial value will become investor 2's initial value, students. So Abrikesh is asking, it holds true even in yesterday market situation. Difficult to answer, Abrikesh. Maybe we can have some viewpoint of C. Ashish sir also on this later on. Yeah, I understand it is for academic purpose only, but there are a lot of factors. I mean, yesterday's factor because of the political outcome, right? So as far as the theoretical part is concerned, the market forces will act in such a manner that if tomorrow's value is same, so today's value will also be same. If tomorrow's cash inflow is 10 for two different portfolios, the today's cash outflow should also be same, whether it is 9, 8, whatever it is, but it should be same for both the portfolios. Otherwise, what people will do? Okay, in this case, I'll tell you. In this case, investor 1 has really gained over investor 2. Correct. Because investor 2 has formed a portfolio by spending 165. Here, investor 1 has formed a portfolio by investing only 160. So in a way, investor 1 is in a beneficial position. So what will happen? The demand of put will increase. People will try to make this portfolio more and more. The demand will increase and hence the price will increase. the demand for call will decrease and hence the price will also decrease. And it will match at that level where the initial outflow will be same. So this is what put call parity theory says. This is, I hope now this understanding is clear. Is a very logical understanding that we have tried to derive. Value of put plus spot is equal to value of call plus present value of the strike price. So with this, students, if sometimes in question, out of these three elements, we are given two elements. Sorry, three out of these four elements, we are given only three elements. Can we calculate the other one? Yes. Right? So I think this is the question that I was talking about, question number 15. Right? This we would have covered in our detailed sessions. I request all of you to please understand it. This is purely based on the concepts that we discussed and totally calculation related, formula and calculation based students. Yes. So now let's come to the discussion of Greeks. Okay, just a second. Yes, students. So what are Greeks? Now, if you see the valuation of an option, which is either a call option or a put option, is dependent on a lot of factors. What are they? Spot price, then time to expire, volatility, right? And there are multiple factors on which the pricing is dependent. If something changes, the price will change. So the first factor is actually delta. What happens if the spot price moves by 10 rupees? It is not necessary that the value of your call option will also increase by 10 rupees. Let's take an example. Let's say the strike price is 100, the spot price is 110. Okay, let me write it down here for the better understanding. So we are talking about the value of call option. Value of call option, let's say, is 7 rupees. I'm taking here. Strike price is 100. Spot price is 110. This is the situation as of now. Okay. Now what happens after 1 month? Strike price will remain 100 only. Okay. Let's say the spot price has moved to 120. It has jumped by 10 rupees. Okay. It can happen. Yes. Now what we're trying to say is that ideally this 10 rupees increase will result in a higher premium, but it will not exactly result into 7 plus 10. It will not exactly result into 7 plus 10. It might be 7 plus, let's say, 8, 9, whatever it is, depending on a lot of other things. And hence we say that one share never used for one call option. Actually, if I tell you, this situation is somehow possible, but in very rare circumstances, 7 plus 10. This will happen once it is deep in the money. So this is a term called deep in the money. Okay. So this situation is possible that for every 1 rupee change in the spot price, 1 rupee also changes in the call option, the value of the call option. So Abhishek is saying premium might have been decided at the time of deciding the option, how it can change for future spot. That is why Abhishek it's a derivative, because it is deriving its value constantly from the different spot prices. Okay, don't understand that premium once calculated will remain fixed. It's not like that. Premium will keep on changing because initially, let's say the premium got calculated as 7. That is basis time to expire of 6 months. That is basis spot price of 110. But situation is not going to be same tomorrow. Tomorrow, your 1 day will expire out of the time period, and hence the premium slightly will get reduced because of time value of money, and major change will come on account of changes in the spot price. Okay, so it's not stagnant. It will keep on changing, Abhishek. Okay. Perfect. So what I was saying is 7 plus 10 might happen in a situation where the option is deep in the money. What do you mean by deep in the money? That means that spot price is way higher than the strike price. And that option is giving us real benefits. I mean, whatever 1 rupee change happens in the spot price, it will result into the 1 rupee change in call option. Okay. I hope this is understood, and hence the concept of delta. Delta is actually this hedge ratio only. For one call option, how much shares, which is actually given by this formula, change in the value of call option divided by the change in the spot price. Similarly, for put option, change in the value of put option divided by the change in the spot price, students. Simple. So the extent of change is actually called as delta. We also discussed, students, that delta, which is the hedging ratio, ND1 and minus N minus D1, right? This we discussed in the valuation of put option. This we discussed in the valuation of call option. So always ND1 is a positive value. Why, students? Why? If you see the spot increases, the call will increase. The spot price decreases, the call value will also decrease. So hence, this is a very good correlation where we say that ND1 will always be a positive value. Minus N minus D1 will always be a negative value. Sorry. Why? Because if the spot price increases, the put option price decreases. If the spot price decreases, the put option price increases. Okay. Clear? This is what I think we were trying to discuss here. So delta for call option is positive and it is negative. So these were the payoff, students, that we discussed. All of you will remember where we said that strike price was 40, premium was 5. Sorry. As the price keep on increasing, their payoffs also got increasing, right? So till here, This is out of the money, students. Till 45, it is out of the money. On 45, it is at the money. Sorry, till 40, it was out of the money. At 40, it is at the money. And more than 40, it will become in the money. Because if the price moves more than 40, it will result into the in the money numbers. Now, this is a very important correlation. Delta is zero when the option is starting from out of the money and slightly increasing from 0 to 1 when the option moves from deep out of the money to deep in the money. Okay, students. See, if you see here, till the time it is out of the money, the value of call option will be always zero. That is why the delta will always be zero, because whatever spot price you changes, it will not change. So it will slightly increase once you are at the money, and once you are in the money, it will become 1. Here, in case of put option, delta moves from 0 to -1. We said it's negative, right, students? As its stock price decreases. Now, if you see here, delta cannot exceed 1 because the value of call option, change in the value of call option cannot be beyond than the change in the value of the spot price, students. Okay. This correlation is clear. Now, this is the put option holder, the slope. So if you see here, slope becomes 1 here if the prices are lower, right? In case of a put option, the prices are lower than the strike price, then it will mean that you are in the money, and hence it will derive your put value, right? Otherwise, if you're out of the money here, the delta will always be 0. So out of the money 0, in the money -1. So students, lower the spot price, put option will be in the money, and hence delta would be -1. This is what we were trying to say. And I think this is one more relationship. So we say that delta is hedge ratio that we have already used in our formula, minus n minus d1 and nd1, right? So in totality, this is 1. If I say put delta is equal to call delta -1, or I can say put delta plus call delta is equal to 1. Sorry, I my bad. Call delta minus put delta is equal to 1. Okay. Gamma. Now, I hope students that delta Greek is okay, and this, I mean, it's clear to all of you. Delta has a very big role to play in all the hedging. Whenever you want to decide that what is the right hedging percentage, it's always delta, right? Because it gives you that relationship between what is the quantity of that underlying and what is the quantity of that option that has to be entered in. Let's come to gamma. Gamma measures the rate of change in delta as the underlying spot price changes. Now, students, if you see, delta is also not constant. Delta also keeps on changing. As I said that as I said that out of the money options has a delta of 0. in the money options has a delta of 1 and -1, right? So with the spot price changes, delta also keeps on changing. As the delta changes, with changes in the spot price, gamma measures the change in delta with the change in spot price. Okay. So it is delta of delta. Can we say gamma is delta of delta? The answer is yes. Gamma is always highest for at the money options, because at that point of time, delta is changing very rapidly. Because at the money options, let's say just before at the money option, delta was 0. The moment option has become at the money and it has come out of the money, then the delta value has suddenly increased from 0 to 0.10. That means the gamma is highest because the change in delta is also highest. Now, moment it becomes in the money, delta will become 1 and delta will not change. 1 will become 1 only when it is deep in the money. So gamma is lowest at that point of time, or gamma is 0 only. Correct? Because there is no delta change. Deep in the money and deep out of the money will have low gamma, that I said, right? So gamma is equal to delta of delta divided by delta of spot price. So this triangle is actually also called as delta. This is called as delta. So we are talking about delta of delta divided by delta of spot price. Okay. By delta we mean change, increase or decrease. Students clear? Delta and gamma both are clear. Any queries till now, students, on this? Okay. Now let's come to Vega. Now the sensitivity of option price to the changes in volatility, students. Now tell me one thing. If let's say I'm calculating a volatility of market returns, right? I'm calculating a volatility of market returns. And that volatility comes out to, let's say, 40%. So then what does that 40% denote, students? And if I simply give you a relative incidence here, wherein I say that this 40% volatility has increased now to 60%. And the reason for increase is because we have seen the actual prices moving. Abrikesh, I didn't understood your question. You are saying difficult to ask as it is very much technical. It requires deep insight before exam. I don't know. See, our current knowledge on volatility, I'll tell you where all we have discussed. We have discussed in the advanced capital budgeting. We have discussed in portfolio, right? And we are discussing now in derivatives also, students. So volatility, as we said, that is standard deviation, right? Standard deviation of your past historical data or futuristic data, as the case may be. Now I've given you a core. I have given you two situations wherein when I'm saying volatility is 40% and second I'm saying volatility is 60%. So do you think that the increase in volatility will cause for higher uncertainty? Yes. If the uncertainty is higher, the price of that option will also become higher. The answer is yes. Okay, so this is what I was trying to establish here. So if you see the formula of D1, it is made in such a manner that if you increase the volatility here, it will increase your D1 and hence it will increase the higher value of the call option, students.
Devas sir,
Yes, sir.
as the student is finding is quite difficult for such a too much technicality in the Greeks. we can touch upon the basics
Sure,
concept.
sure, sir.
Okay,
Understood.
because our here purpose only to only just because we have not the coverage is not that much in depth.
Okay, sir. Got it, sir. Got
Okay,
it.
because we were from the examination point of view, it is basically touch upon only there.
Sure,
How,
sir.
what
Sure,
is
sir.
the sensitivity of a one factor vis-a-vis to the option pricing? Our purpose
Perfect.
here to make them understand only there.
Perfect. Perfect.
Okay.
Perfect. Sure, sir. Sure, sir. Got it, sir. Okay. So Vega is the sensitivity of volatility. Then let's come to rho. Rho is basically the sensitivity of option prices to the changes in the risk-free rate, students. Because as we understand that the formula also includes risk-free rate, and hence that will also impact the value of the option. Now, if the rate increases, call option value will also increase, but put option value will decrease. So this is the sensitivity relationship of this risk-free rate, students. Similarly, if the rate decreases, the value of the call option will also decrease, but the put option will increase. So it has an opposite effect on the put option. Okay. And this we tried to actually put down this simply saying that if R is higher, right? So the present value factor is getting reduced here, and hence call option value will be higher. In this case, R is higher, so it is getting added, right? And hence the value of put option is getting reduced. For simplistic terms, please remember call option has a direct relationship, put option has an indirect relationship with the row. Then I think last Greek, which is theta, is actually the sensitivity of the option price with the passage of time. And as we discussed, the time passes, the premium, the time value of money within the premium also reduces, students. Okay. So this has the similar relationship with both call and put option. Yes. So finally, we have covered Greek, students. Delta, which is the changes in the price because of the spot price. And gamma is actually the changes in delta. Vega is volatility, rho is rate of interest, and theta is time passage. Okay, students. Now I think with this, we have covered our discussion on the options, I mean, forward futures and options. So I suggest let's have a break of 10 minutes now, and then we will cover up the balance aspects. Thank you, students. Students, welcome back. Now we will discuss on the other topics of derivatives. Let's start our discussion on another type of derivative called as credit derivatives. So students, there are different types of risks in the market, correct? One is definitely a market risk, and second one is the credit risk. What do we mean by credit risk, students? Credit risk is simply the risk on account of non-payment. Let's say today I give a loan to someone and that person is not able to repay me back the amount. That is called as non-payment risk. They might get default, they might not pay me the interest as well. So that is called as non-fulfillment of obligation by the counterparty. Sorry. So whenever that obligation becomes due for that counterparty, they are not making that good. Similarly, for market risk, students, these are overall risks that a company expects. For example, price, it might be related to price, interest rate, stock markets, exchange rate, anything, right? So if you see the forward, futures, and options, everywhere we have covered all the underlyings. We've tried to cover all the underlyings which are related to the price of the equity share, index, interest rate, stock market, let's say stock market at a collective level, right? The market index and exchange rate we will be studying later on. So we have already covered the financial part of the market risk in forward, futures, and options. Now in credit derivatives, we will actually see how we can work on this reducing the credit risk through some of the techniques. Clear? So derivatives used to hedge against the credit risk are referred to as credit derivatives, students. Now it has two parts. One is collateralized debt obligations, which is called as CDOs. And the second one is credit default swap, which is CDS. We will cover both the aspects. So from our securitization knowledge, students, we understood that there is a originator, which is essentially a bank. This originator gives mortgage loans to the borrowers. Okay. These are the borrowers. And then this originator assign these mortgage loans to SPV. And SPV will pay the amount to originator. What this SPV will do, SPV will attract investors. It will break down this entire mortgage loan into different marketable securities. So these are marketable securities. So SPV will create, it will divide the entire amount into different marketable securities, students. Actually, this is called as a MBS, which is mortgage-backed securities. The securities that are issued by SPV to the investors. So students, it is very easy and simple. I'm just trying to explain the different terms, right, which we will be using in these concepts. That's all. So please pay your attention. So marketable securities, which are actually broken down from by the SPV to the investors, in case of a mortgage loan, is called as a mortgage-backed security, MBS. We call it as MBS. In case, let's say the originator assigns to SPV anything other than mortgage loan. It can be others also, right? It can create a pool of personal loans. It can create a pool of some other obligations. And then that pool can be sold to SPV or it can be assigned to SPV. In such a case, that is called as asset-backed securities. It's not a mortgage, right? Mortgage is something related to the home loan, where the home is kept as a mortgage. So the car loan as an underlying is there. Pool of that is created, transferred to SPV. SPV will create marketable securities. Marketable securities will be issued to investors. these marketable securities, in case the underlying is car loan, will be called as asset-backed securities. Clear? Now, in this case, we have discussed, let's say the mortgage loan, 1,000 numbers of 1 crore each, let's say 1,000 crore. 1,000 crore is the pool of those funds. Now, if you think it from the perspective of bank, or let's say this SPV, how they think, they will say that this is a pool of funds of 1,000 different people. Some of them have good paying capability and hence lower credit risk. Okay. Now we have to actually link it to the credit risk, right? Some of them have poor paying capability and hence have higher credit risk. Okay. Now they want to analyze this. So what they do, they go through the entire book. Okay. They go through the entire loan book and they come to know that, okay, 80% of the profile to the people to whom it is given, they are okay with that. And they anticipate that there is no loss that will happen. Only 10% interest will not pay and 10% completely it will not be paid. Let's say this is their analysis. It can be anything. I'm just taking an example, right? Because out of that analysis, it will come, right? How much will be able to 100% pay? How much will be defaulting? What is the percentage of default, like that, right? But one thing is clear, that all of them will never go bad. A percentage of them might go bad. By going bad, I mean they will not be able to repay. So this SPV has this analysis now. Okay. Now see, what will SPV also do? SPV will also create mortgage-backed securities, MBS, in such a manner that the onward risk, let's say the risk of non-payment because of this pool of assets being taken over, is also passed on to the investors. In what manner? Just a second. Abrikesh is a question. This is by number of borrower or by amount? It can be both, Abrikesh, right? In this case, I have taken a simple example, 1,000 borrowers into 1 crore amount. Okay, the analysis will be, it will have both the things. Okay, now, so how SPV will think now? SPV will create 3 different tranches. And this we are talking about investors. So senior, mezzanine, and equity. So it will create 3 different tranches. Why? Because SPV is also running a risk. SPV is also running a risk of non-payment, credit risk. Now, the way it will create is, it will create the first tranche as senior. This is called as senior because it will give you a fixed return. So SPV, while issuing, it will say that the investor will get a fixed return on this senior amount. And it has a low risk because the return is fixed. But the percentage return will be lower, students. Correct? Because low risk means low reward. Okay. Then the second tranche that they will create is mezzanine. Mezzanine is something in between. So mezzanine will have a medium risk, somewhat higher than senior and somewhat lower than equity. Let's say banks agree for the mezzanine tranche, but they will get 6%, a return bit higher than what it is given to senior because they are taking higher risk. Lastly is equity, students, where we get variable returns. In case of a variable return, it is totally dependent on how much bad debts goes, on how this book loan is performing. They have a high risk appetite and hence they are kept into the very high risky situation. I have taken an example. Let's say these are high net worth individuals. These are HNIs. And let's say because of the higher risk, they are getting a return of 10% students. Clear? So now let's connect it back to the credit derivatives. In credit derivative students, we discussed about two things. One is collateralized debt obligations. Second one is credit default swap. So this collateralized debt obligation, CDOs, is nothing but this entire tranche that has been created. You see, collateralized debt obligation is stemming from this asset-backed securities and mortgage-backed securities for which we create different tranches depending on the risk and return profile students. Clear? Okay. Now let's say 20%, as we said that there is a total 20% credit risk. Out of that, 10% will not pay us interest. Another 10% will not pay either interest or principal. Okay. If we have not created tranches, then we would have only one option, right? But in this case, since we have created tranches, hence we have eliminated the credit risk in some tranche and increased the credit risk in the other tranche. That is why it is called as a credit derivative, because we have treated the credit derivative to some extent, students, for some of the categories. Now here we said that CDOs are of two types, ABS and MBS. ABS is actually pool of funds, REIT, CDOs, it can be anything, and mortgage backed is for the mortgage. I think then these were two types of CDOs, students. I hope the CDOs are clear now, correct? Then there are different types of CDOs. One is the cash CDO and second one is the synthetic CDO. So the cash CDO is actually the originator will sell the underlying to the SPV. It will sell the entire loan book to the SPV. Synthetic CDO. In synthetic CDO, originator will only transfer the credit risk to SPV, for which SPV will charge commission. And that credit risk was how much? 20%, right? In which 10% interest were not giving and 10% interest plus principal, both they were not giving. Correct, students? In the previous example. So in synthetic CDO, the actual loan doesn't get transferred, only the credit risk gets transferred to SPV. Then SPV will do tranches. SPV will do tranches for that one. See, cash CDO, collateral assets are moved away from the balance sheet of the bank. Synthetic CDO, no actual transfer of the assets. Instead, only economic effect is transferred. Only we are transferring the economic effect of this credit risk, students. That's all. So there are these certain risks that are involved in a CDO. One is default risk, right? Default risk means that okay, Abrikesh is asking what is economic effect? Economic effect is actually the, so let's say it's not the real transaction, but the effect of that transaction. So if you see, Abrikesh, this transaction is having an impact on the credit risk, right? To treat that credit risk, we have transferred the credit risk to SPV, which will make the different tranches. So only the effect has been transferred. The underlying is still with bank or the originator. Okay. Now, risk involved in CDOs, we said that default risk is understood. Interest rate risk. Sorry. So interest rate risk, students, is the basis risk. Now, what happens in this? If the interest rate moves up or down, it will definitely impact the CDOs. Sorry. Liquidity risk, students. Liquidity risk is the matching of the asset realization with the matching of the liabilities payment. So timing of receipt is not matching with the timing of payments. Once when you need to pay, you are not having any funds. Sorry. Prepayment risk. Now, what happens in case of a prepayment? You would have seen a lot of people who have taken home loan. They will prepay that home loan. The moment they prepay that home loan, the bank's cash flows gets distorted because they are receiving more than expected. Sorry. So next one is reinvestment risk, students. Reinvestment risk is, let's say today we have invested at X% and for maturity of 3 years. Once the maturity comes, at that point of time, the rate will be different. I'm sorry. And hence there is a reinvestment risk to that effect. Foreign exchange risk, the movement in the foreign exchange rates, correct, will also lead to the changes in the underlying amount in case this is a cross-border transaction. Okay. Then let's come to the credit default swap, students. So as the name, so this is the second type of credit derivative, students. As the name suggests, credit default swap. So credit is what? Credit is loan that we give to someone. Default, we have already did enough discussion. It's non-payment. Swap means exchanging it with someone. Okay. So what we are doing here, there is a, you imagine, for example, a insurance company. That's the best example. So why do anyone go to an insurance company? To make sure that insurance company takes over the liability, or it gives us that assurance that tomorrow, if some loss happens to you, we will make good that loss. But in return, you pay us a premium, correct? So there is a concept of protection buyer and protection seller. In such a case, protection buyer is whom? Protection buyer is the person who is going for insurance. Protection seller is the insurance company because they are selling the insurance coverage to the respective people. And you will end up paying a premium, let's say 0.5% of the loan. So now let's transfer it, or let's say let's understand this in the terminology of credit default swap. Here the protection refers to the protection from the credit risk. Okay. As I said that credit risk is the risk of non-payment. Here the protection is happening against that credit risk. So any default, so we call here it as reference obligation. So there's a term called reference obligation. Reference obligation is the underlying for which the protection is bought or sold. Okay. So any default on reference obligation will be made good by the protection seller to the protection buyer. Let's say protection buyer has given loans which has credit risks. Those are called as reference obligation. Now this protection buyer requests the protection seller to provide him insurance for any of the default that happens. But protection seller says that, okay, then you pay me a premium for that, which is let's say 0.5% of the loan. And I will give you a protection of whatever default happens, I will make it good for you. So this is called as credit default swap. Very easy and very simple, friends. I'm defaulting, I'm swapping my credit risk with the other party for the payment of premium. Okay. And here, as I said, that reference obligation is actually the initial borrower's list. Okay. Now, reference obligation can be bonds, corporate debts, loans, even trade receivables, students. If you see, trade receivables are also reference obligations, right? Because there also there is a credit risk. There is a big amount of credit risk that the debtors might not pay, and mortgage loans. Protection buyer is exposed to the credit risk of the reference obligation. That is the situation currently, right? Situation current. Let's say loan of 10 lakhs multiplied by 10% per annum. So this is what we have given as a loan. And as we said that protection seller is very much similar to the insurance company. Now, there are two types of settlement, students. One is physical and one is cash settlement. In case of physical, the actual delivery of the bonds or underlying will happen. But in case of cash, only differential payout will happen, students. Clear, students? So, this is what we discussed in relation to credit derivatives for past 15-20 minutes. Credit derivatives, as I can recap, is something to do with the credit risk. We have two types of credit derivatives: CDO, credit collateralized debt obligation, and credit default swap, CDS. CDO is linked to the securitization concept that we have studied, wherein it tries to differentiate the different risks and return elements into different tranches. And CDS is actually swapping your risk of credit with the other things. Okay. Now, students, let's come to commodity derivatives. Again, a relatively very easy topic. So, students, okay, let me first hide it. Can anyone tell me how do you differentiate whether something is called as a commodity or not? Let's say in practical life, you would have heard something that this is a commodity. But what is the real meaning of commodity? Or let's say, what are the basic features of a commodity? Can I say house is a commodity? Can I say pulses are a commodity? Can I say oil is a commodity? Right? So what is that we should ideally say that it is a commodity? Because if underlying is clear, then derivatives is automatically clear. Hence, if someone wants to attempt this, you can please respond. Okay, Abrikesh is saying it is tangible. House is also tangible, but do you think house is a commodity? Any immovable property is a commodity. Munish, maybe you want to answer? Okay. So these are the basic features of commodities. They are durable, first of all, right? They have some shelf life. Second is they are homogeneous. You would remember in the previous discussion, we discussed about grade A crude oil, right? So grade A crude oil will be homogeneous. Everything is very much similar, same grade within this grade A crude oil. There are good amount of price fluctuations that is dependent on the market supply and market demand. Correct? What is the demand looking like? What is the supply looking like? That will accordingly derive the price. And we say that supply is maintained at a consistent level in the market. It's not that it's very seasonal. Supply is not seasonal. Demand can be seasonal, but supply is not seasonal. Okay. So these are the basic features of a commodity. Then we say something as commodity. For example, oil is a commodity. For example, pulses are a commodity, right? For example, vegetables. In this case, we have taken an example of a corn. It's a commodity. Now let's take an example, student. There is a farmer who is engaged in the farming of corns, right? Now that corns are used as an input by a company called Kellogg's. They are using this as an input for producing an output, right? And from a farmer's perspective, if you see, farmer's output is corn. And hence the risk that farmer is exposed to is the risk of price going down, students, right? Because see, the manufacturing, or let's say the production of the corns will, let's say, take some time. Now today there is X price in the market, and since it is a commodity, the pricing is fluctuating, correct? As we discussed, the prices are fluctuating. So tomorrow he might not get a good price. So he's worried for that. On the other hand, Kellogg's company, since they use this corns as an input, they are worried that the prices should not go up. They are exposed to the risk of a price going up. Correct? I hope the problem statement is clear, students. Clear? So commodity futures are actually regular futures. It's just like a very regular future. Now, the underlying in case of a commodity derivative will become this corn in this specific example. So what farmer will do, students? Now tell me, come on. What I should do so that I gain in case price goes down. Should I purchase futures or should I short sell futures? Very good, Abrikesh. Abrikesh has answered. We should short sell the futures. Simple. So that is benefit here. And for Kellogg's, it should purchase the futures. Because tomorrow if the price goes up, futures is purchased, he will get a benefit on the futures. Right? Kellogg's will get the benefit on futures. Now commodity derivative, students, has an underlying as commodity. And there is a multi-commodity exchange we call as MCX. For example, gold, silver, copper, all these are also commodities, right? So on this, all these futures prices are also appearing. Now, there is a term called commodity swaps, right? Now, in this case, students, we have seen that the prices were fluctuating. So there is a product available for a commodity swap which will convert the floating into fixed. So fixed floating swaps convert the floating price to fixed price. And second is commodity for interest swaps. In this, commodity will be swapped for the interest rate. Let's say 8%, right? Whatever the price is, that will be swapped for the interest rate. So that your earning is limited, let's say, or your earning is not impacted. Okay. Okay, students. So only one thing in commodity derivatives, it is very much similar to what we have studied till now, right? Even we have to calculate the valuation of a commodity future. The formula is also very much similar. Okay. Now let's come to weather derivatives. Perfect. Now, students, if you see, there are a lot of companies whose output is dependent on certain weather conditions. Correct. And since output is dependent and hence overall business is also dependent on that, right? So the business gain or business loss is actually dependent on how weather phases out. So in weather derivatives, the underlying is a specific measure of a weather. What are the different types of specific measures of weather, students? One is, let's say, rainfall measurement, right? That happens in centimeter types, right? Second is humidity. Third is temperature. There can be n number of specific measures of weather, right? So in the weather derivatives, the underlying becomes weather. And if weather changes impacts the losses or gains of a company, accordingly, the position can be taken in a weather derivative. For example, farmer is dependent on rainfall. That is underlying. And please don't confuse it with an insurance contract. We're not talking about insurance contracts where, let's say, the earthquake or flood comes and insurance company will make good that loss. This is not that. This is simply we are fixing, or let's say we are entering into a contract whose value is dependent on how the weather changes. Okay. Let's say uh, the weather, we say that it's 25 degrees Celsius. Okay. So the future, it says that 25 degrees Celsius, if it is higher or lower, then accordingly the settlement will happen. And also, as we said that weather derivatives are not covering the extreme weather situations, for example, earthquake or floods, because those are covered under the insurance contracts. Okay. No, so Abhishek is asking how weather underlying can affect positively, as either weather can be normal or bad or not good. Okay, no, Abhishek, what I'm saying is the terms becomes favorable to you. See, ultimately in the entire derivatives, either you will end up having a favorable outcome, or having a non-favorable outcome. In case you don't have a favorable outcome, then you will lose. In case you have a favorable outcome, you will win. Okay. Favorable outcome compared to those terms that those are mentioned there. Okay. Yes. So what we were saying is that these derivatives can be used in case, because of the weather, some price or value is getting impacted, or because of this, the volume is getting lost, right? Because let's say it is not getting produced and hence we are not able to sell it. Okay. Then, for example, data. First of all, there are some challenges in weather derivatives. The data has to be correct. Then the forecasting accuracy of weather, right? That might involve some of the temperature modeling, right? Because let's take an example. If 40 degrees Celsius is the temperature, we will reach our optimum level of production. If it becomes more than 40%, then we will lose 1,000 metric ton. That we know. That is a scientific correlation that we've already derived. So what I will do now, I will bet saying that if the temperature goes up, it should be favorable for me, right? So I will say that temperature going up should result into a benefit for me. So I will long, or whatever the derivative is, I will take the according position. So that 1,000 metric ton losses is recovered. Then students, the last topic from my end actually is the electricity derivatives. Uh, on the electricity derivative, students, as we understand that now whatever types of derivatives we have studied, commodity derivatives, credit default, credit derivatives, weather derivatives. In all these three things, the underlying is the first part. Here the underlying is electricity. Now what happens, students? There is a power purchase agreement. Let's say I am a supplier. Let's say any company produce electricity. So the government purchases it from that company using that power purchase agreement. Now the power purchase agreement yes. Now in that power purchase agreement, it will mention how to calculate the pricing. And we also know that the electricity prices are also fluctuating, right? Think it from a commercial perspective, right? So in a way, electricity also becomes a risk to us, right? The prices of the electricity also becomes a risk to us. Now, if we have to hedge against that risk, we will make use of the electricity derivatives, right? So it is for both the ones that are producing the electricity and the ones who are consuming the electricity. And the underlying here becomes the spot price of electricity, students. Okay, so I will pause here. Okay, so these are also examples. Electricity swap. Yes, Abrikesh. So electricity is not traded in the market, but we sell electricity to the government and we purchase the electricity back from the government. Okay. Electricity swap is very much similar to the interest rate swap, wherein the floating rate is converted into the fixed rate. So this IRS we will be studying later on in the next topics. But swap means exchange, simple. And fixed to floating, floating to fixed means that the floating rate gets changed to fixed or fixed rate gets changed to floating. Okay. So let me take a pause of 30 seconds and check if there is something that is unanswered for the concepts that we have studied till now. And after that, let's do one practice question also. Let me find it out that. So Abrikesh, there is a question from your side. Just a second. Yes. Example, in case of rooftop solar, etc., company buys at very low rate. Yes, that is to do because it is a solar energy application. Okay. Now, question number 12, students. Let's focus on this question. So this is from the concepts that we have discussed in the previous session. A 2-year tree for a share of stock in ABC Limited is as follows. So today the price is 100. N2, which is 1 year later, higher is 108, lower is 95. Similarly, after 2 years, there can be again two possibilities, 116 and 102. And similarly, for N3 also, there are two different possibilities. Consider a 2 years American call option. Now, they're talking about an American call option on the stocks of ABC Limited. The expiry of this option is 2 years, students. And the strike price is 98. The current price of the stock is rupees 100. Which is also evident from the N1, right? Risk-free return is 5% per annum with a continuous compounding. So see, now they have given us a 5% equivalent rate of continuous compounding, which gives us 1.05127 students. Assume 2 time periods of 1 each year. So they are saying you have to break the 2 years into 1 year each. Okay. Then using the binomial model, you need to calculate the probability of the price moving up and down. Can we calculate that? Yes. Second is expected payoffs at each nodes, that is N1, N2, and N3, round off up to 2 decimal points. Okay, so N1 we have to do, N2 and N3 we have to also do. So probability of the price going up is equal to R minus D divided by U minus D, that we have already discussed, students. R is what? R is the continuous compounding factor. Which is e raised to the power 0.05 minus the price that has gone down is 95 vis-a-vis 100. So 95 by 100. Here it will become 108 divided by 100 and 95 by 100. Okay. So the probability comes out to be 78%, students. Here. If the probability of price going up is 78, the price going down becomes 22%, students. Okay. So first part is answered, which is easy. We can also calculate it using the risk neutral method, students. The answer will remain same because both of them are derived from each other. Expected payoffs at each node, that is N1, N2, and N3. For that, students, we have to first calculate the expected payoff from the farthest location. Let's say from the farthest year. So we have to always move from right to left like this. So first let's calculate here what is the payoff, here what is the payoff, here. Then we have to take the present value to arrive at first year, and accordingly we have to calculate. Okay. So at N2, students, N2 has two more outcomes, 116.4664 and 102.60. Just a second, what is the strike price? 98, right? Yes. So 116.64 minus 98, right? Multiplied by the percentage of the price going up, that is 78%. And the percentage of price going down is 22%, and the price itself will become 102.60. So 102.60 minus 98, there is a 22% probability. All divided by the present value factor. Okay. So N2 will become 14.79. The payoff at N2 node will become 14.79. Now let's talk about N3. Now within N3, the payoff will be this much, 102.6 and 98. So here there is a payoff. We are talking about a call option, that's why. But in this, there is no payoff because the price is already below the 98, which is 90.25, students, if you see. Right? It is below the strike price. Okay. So this will give us 0 into 22%. And hence the overall N3 number becomes 3.41, students. Now N1 will be a probability adjusted value for N2 and N3. Simple. Divided again by the present value factor. So the payment at N1 becomes 11.69, students. So this was the question on binomial method, right? Adapted from the earlier ICAI examination. Okay, students. So students, any question till now from my end, please do let me know. Okay, so now students, we are done with the part that I have taken in the recorded sessions. I would request now C. Ashish sir to please take up the other parts of the topic. Thank you, sir. Thank you, students.
Okay, thank you, Devas sir. First of all, just can you stop your sharing your screen?
Sure, sir. I will do so.
Okay. And if possible, you can switch off the camera.
Sure,
and,
sir.
Whenever if there, but remain with us, stay with us.
Sir, I want to attend your session. Actually, I want to know these options because I've been able to understand it.
Okay.
But
it's up to you. If you can comfortable to keep on your camera, then there's no.
Sure, sir.
Okay, students. With this, we are coming to the next part, that is real option. Now, when we are discussing the real option, I am just sharing my screen. Now, students, when we talk about capital budgeting decisions, of course, this topic has been widely covered in the at intermediate level, as well as we have also covered in the chapter number 3, that is advanced decision in capital budgeting. Now there is always a one very basic assumption that the capital budgeting decisions cannot be reversed. However, when we discuss the real options decisions, basically this concept defies this basic assumption. According to this real option model, we can define, we can they say, of course, this decision can be reversed, but of course we cannot reverse the decision, but some options are left with us how we discard or how we discontinue the capital budgeting decision. So generally, these options can be say discarding. This is called abandonment. Okay, and even we can also modify the project at later stage. So all options are available, and even sometime there is one category of option that we will discuss: wait and watch. Sometime we shall see that the maybe option may not be available well, we can say it not be approved fruitful at if we evaluate at this point of time, but it may be possible that due to changes in the market condition, this option maybe become viable, this project may be become viable. Now let us see, just I have given a very have you seen the notes. Now there is one in the project, okay, it is requiring say initial investment of say 1200. Okay, now it gives a cash flow of will give rupees cash flow for annually on perpetual basis. So perpetual basis means it will be for a period of indefinite period. Okay, if discounting rate is 10%, should we accept the project or not? So then we say cash flow divided by discounting rate minus initial investment. Of course, when we say 100 divided by 0.10, okay, so this become rupees 1000. Okay, when we deducted 1200 from it, this amount sum become minus 200. So of course we shall say we should not accept the project, but that is not the so case. Okay, because if we see, if we wait for a 1 year, it might be possible that the discount rate, or it may be possible that our cost of capital may be reduced to 0.5%. Then in that case, what will happen? Of course, we carry out the same exercise there. That is 100 divided by 0.05% minus 1200. Okay, now this will be become our 2000. Okay, 2000 minus 800. Now this option will become viable now. So we see here how it has changed. How it has changed. So this is basically we see that if we wait and watch, it may be possible that this option may be viable at some point of later sometime. So on that basis, when we compare financial option and real options, of course, so that's why what happens generally the concept of options, generally concept of derivatives, or generally, but in the derivative, basically the concept of options are applied in capital budgeting decisions, and that's why they are called real options because they are related to the real world. Okay, so before we proceed further, it is better if we understand what are the differences between financial options and the real option. Of course, the concepts of the applicability will be on the same line. Only the underlying here will be our first we see the underlying concept. What is underlying? Here in the financial options, the underlying can be stock, bond, commodity, interest rate, etc. Now in this interest, etc., I add up just 5 minutes or 10 minutes back. The Devas sir has discussed electricity, weather. Okay, these are also the derivatives now underlyings are there. Similarly, but however, when we talk about the real option, the projects are okay. The underlyings are projects, capital projects are there. Okay, now next we see what are the payoff. Generally, in this payoff are fixed. For example, in case if I buy a call option or I buy a put option, okay, of course I buy a call option. Okay, so I am buying a call option, say for exercise price of 120. The share may be trading at 100 rupee now. Now I'm paying a premium of say rupee 2, somewhere around this. Now I hope that suppose in the market after some stipulated period, the price comes to 130. Of course, I will exercise my option. But at this moment of time, my cash flow is fixed. of course, I will sell in the market, that I will gain. But I know that I have to outflow 120. Okay, of course, premium is there, but of course, I am what I will gain from the market, that is sure. So I know that if the exercise will be there, then I will get this much of amount. But in cash capital busting, generally cash flows are uh, estimated. Okay, of course, estimated. We also made it, but in capital busting, the variability factor is quite higher. Okay, because the time horizon is quite long. Please, it is always remember, say, if we have to predict something. Now I just give you a very simple example. Now every 5 years the elections take place, general elections take place. Now if we are making any decision based on the long term, so of course our cash flows may be likely to be affected by the general election result. But if we are making some short term investments, so our decision may not be that may fluctuate very much. Okay, student. Now, next is exercise price. Now, exercise period. Generally, the period are short term, as I discussed. Generally, the cash flow start at the end of 1 year and has the long period that I have covered. Now, approaches. Now, they are priced for trading purpose. Okay, whether I should go for trading or not. Generally, they are valued. They are not priced. Generally, they are valued because there are no buyer for the same. Okay, generally there are no buyer. The things are priced means there are some buyer there. Valued means we have to make some decision. Okay. Now, of course, from this point is related. This can be traded, but this cannot be traded. So, student, this was the basically fundamental difference between real option and financial options. Now, when we talk about real options, of course, there are various categories. Generally, these are used because we have matched what or you can say we have made a parity between the financial option and real option kind of a thing. So this diagram exhibit how the financial options we can make a parity with the real option. Now, option to expand means we have to grow. We can consider it as equivalent to our long call. True. Similarly, option to abandon, it is called long put because abandon means when we will lose when we will discontinue the project. Of course, we shall sell it to some buyer. So of course we will get the money. So it is called long put because we are buying a right to sell something. Next is option to wait. Generally, it is considered as a long call. Yes, we are because call means we are investing something, but we are waiting to invest something. So it is equivalent to long call. Then strategic option. These generally strategic option are like say merger, acquisition, etc. So again, since it involves the outflow, so generally these are category of the long call where we are getting the money. Of course, this is a long put. Now here we have also categorized the same is from your study material, so you won't face any problem there. Now, long call means right to invest something future time, expand the business. Long put means right to sell some future time, that means abandon, and flexibility to or diverse the business. Okay, because it may be possible that we may diverse one part of our business. Next is our short call. Short call means promise to sell if counterparty wants to buy. Okay, we are making a short call. Okay, we are giving the right to the other party that they can buy from us. Okay, with generally commitment to diversification action of the another party. Generally, in this case, the real option call from the other party's perspective, it will be a short call from the our perspective because we are giving them a right. Then it becomes a short put. Short put means we are selling. If the promises to buy, if the counterparty wants to sell, again we have given them the right to sell their project. Okay, one commitment to invest if counterparty so wants. So of course we are investing the money because ultimately we are investing some project. So all this categories has been there. Now, student, very important. As we have done in the financial options, these are the basic models. Devas sir, I discussed with you. Okay, I think you have discussed these two models in the last class, and
Yes.
today you have discussed Black-Scholes model.
Yes, sir.
So here again the same models will be used here in the real option. Only the difference is that there the parameters will be quite different. Okay, that we will see, that I will show you how we can do the same. Now before that, I'm just one more classification I'm making that will also help you. Now what are the basic types of real options? We can also look at the same in other perspective also, because this knowledge is very important. Growth options. Okay, it is equivalent to European call option. Okay, of course, it is a generally what are these options categories are covered, like investment in R&D activities. Generally, these are made in pharmaceutical companies. Okay, these are generally in case of a pharmaceutical companies where the long investment has to be made for patents, heavy expenditure in advertisement. Because its return is likely to become over a period of time. Initial investment in foreign market. To expand business in future. Then of course, acquiring patents or making rights. Acquiring plot to develop it in future, with intention to develop it in the future. So all these, we can say, these are some categories of specially decisions. Uh, because generally from this we can see that generally these are made for the purpose of some you can capital boosting decisions. Now next is abandonment option. Okay, generally it is considered as a American put, because generally in European call option, put option, the time is fixed. Okay, they cannot be made before the expiry of a certain period. But abandonment means generally they are given the flexibility. You can abandon the project at some certain time. Of course, if this flexibility is not there, then generally they are considered as a European put. This option is generally exercised. It is very important when value derived from abandoning the project is more than the value PV of value of continuing the project. Sometimes we may find it, if we continue the project, the PV may not be that much if we sell the same, because it is just like a profit booking. We can say that sometimes we can say that make a profit, book the profit. Of course, there is a timing option. Okay, so it is equivalent to our call option. It can be our American. If we have a more choices, say we can wait for 1 year, 2 year, 3 years, it is American option. Otherwise, if it is only for one period, so we will call it as a American option. Oh, sorry, European option. Okay. Generally, these are used for to wait for ideal situation or ideas. Anything. Okay, student. So you try to understand these are the basic only. Okay. Now what I do, I take you to the our assignment. Okay, where we have solved the questions. Of course, you have gone through the questions. If you have any query, you are free to ask to us. Okay, student. Now this was a question that we have discussed in our earlier class. Now this question says, student, please note that you just uh, cut out this line. Okay. So the it says that Ramesh owns 1 second. Yes. Ramesh owns a plot of land on which he intends to construct apartment units for sale. Number of apartment units to be constructed may either be 10, 15. Total construction cost for these alternatives are estimated to be 600 lakh and 25 lakhs respectively. Current market price for each apartment shall be 80 lakhs. The market price after a year for apartment will depend upon the conditions of the market. If the market condition is buoyant, the each unit will be sold for the 91 lakh. If it is sluggish, the price for the same year will be the 75 lakh. So determine the value of a plot of the land. The yearly rental per annum 7 lakh and the risk-free rate of. Now here, this rider that yearly rental is 7 lakh. Of course, it is giving some kind of a choice that we can let out this property at least for the 1 year. Then we can see. Okay. So accordingly, what we can do, we can say that it is a kind of an option. How much we have to develop, how much plot we have to develop. But since he has asked us to compute the value of the vacant plot, so we have to see all permutation and combination, all possibilities will be there. So for this, we shall use the concept of option. Now let us see what are the various, we will determine the value of vacant plot. Okay, for this, we shall use the risk neutral method because we have to determine the probability of price rise and price falls. The first we do, we compute the payoff after 1 year under two scenarios, buoyant conditions and sluggish conditions. Okay, so there are two conditions. 4 cases will be possible. If we construct 10 flats, this is like our case one. If we construct and market turns out to be buying market, and if we construct 10 flats and market conditions turn out to be sluggish. Another case, we construct 15 flats and market turns out to be buying market. And if we construct 15 flats and market condition turns out to be sluggish market. So all case scenarios have been put here. This will be the buoyant case. It is sluggish case, 10 units and 15. So of course, if we construct market or we can say market is a buoyant market. So of course, price will be 91 lakh. If it is sluggish, of course, it will be there 150 lakh. Okay, now next is 1591 and accordingly 70. So here the difference is number of units. So all possible come outs we have made out. Okay, now if we see, analyze this diagram is stable, we will see that we can say our choice, if we are given the choice. So we will say if we construct the 15 units, of course the market should be buoyant, because by this we are getting a profit of 340 lakh. Now if the market is turned out to be sluggish, so we should save our cost on construction. Okay, in that case, our which option we will prefer? 150. So we will like that there are two cases possible that we will want this type to be case. If we are constructing 10 units, we want the market should be sluggish. Okay, if we are constructing 15 units, so of course we are hoping that the market should be buoyant. Okay, now we construct. Should he construct the flat now or wait? Okay, of course we are considering the case now. If they construct uh, the flats now. Okay, so accordingly, if we construct the flats now, so these are the profits. Okay, 80 lakh per unit, 80 lakh per unit. Now here the profit is 200 lakh, and here's the profit is 150. So we can see that at this moment of time, the decisions to construct the 10 flats, okay, is a viable option. Okay, because here this is the option. So, but accordingly, what to do? We have to determine the what is the probability of this. So because we have to determine what will be the distance. So what we do, we determine the probability of price rise and price falls. Okay. Now here, as on date, the price is 80 lakh. Okay, there are two possibilities. It can be 91 lakh or it can be 75 lakh. Of course, we are assuming that we shall let out this property on rent. Okay, accordingly, there will be an addition of 7 lakh rent per annum in both the properties. So in that case, our cash inflow will be this 98 and this cash flow will be in the 98. Accordingly, when we are using the risk neutral method, simple logic is that if I presume the P is the rise probability of the rise. Okay, if I am assuming P be the probability of rise after 1 year, that is market is in a buoyant condition. So my cash flow will be per unit will be 98. Okay, so of course this I have considered here, and if -1 from this I deduct this probability, this become 8 multiplied with this. So whatever will be this will be, you can say this will be my payoff, expected payoff after 1 year. Okay, this will be my expected payoff after 1 year. However, if I am investing today, so I want some return. So what I say, what will be my expected payoff? I bring it to the present value of the same and I keep it equivalent to 80 lakh. Because right now his price is 80 lakh. According, so I divide it by the 1.10, that is PV factor. Now accordingly, I determine the present value. So not present value, it is the probability of price rise. This is the probability of price falls. So accordingly, using the same logic, I here determine the expected cash flow next year. Okay, this amount comes 2 to 1.25 lakh. Okay, so this is my expected cash flow next year. Now, the present value of this is 201 lakh. Okay, student. So here I have multiplied with this 340 because 340 was my this case. Okay, then this case was 150. I have multiplied with this. Okay, true. So okay, student. So with this, we can compute that this is the expected present value, expected value after 1 year. From this, I deduct this value. So I can say the present value of the plot is this. Here, please note that I have not included this in addition in my computation. You see here, I have not added the rent here because in this table I have not add the rent here because it is just we are determining the value of vacant plot. So generally for the vacant plot, we are assuming that only the construction cost we are considering. Okay, student. So with this, I hope the value of vacant, how we have computed value of vacant plot is clear to you. Now, till now, you have any doubt? Otherwise, we proceed the further. Deva sir, I am asking you, have you any doubt?
No, sir, it was really interesting to understand from you. Thank you, sir. I don't have any doubt.
Okay, okay. I think I have applied the same logic of the risk neutral.
Sure, sir. Sure, sir.
Okay, okay, student. Let me check whether I have received any query or. Okay, I think there is not a query in even chat box also, no?
Yes, yes. Chat box is also not there.
Okay. Now, student, I am coming to the next question. This is the question number 2. Ram Chemical is in the production line of a chemical and is considering a proposal of building new plants to produce pesticides. The present value of new proposal is 150 crore. After considering scrap value at the end of the project, since this is the new product market, survey indicates the following present values. The condition favorable 1 year, first year, PB increase from the 30 from the original estimate. As usual, sluggish, it will fall down. In addition, Rama Chemical has the option to abandon the project. Okay. Now the project at the end of year and dispose it off at the 100 crore. That is the main thing. And of course, if the risk-free rate of 8%, then what is the value present value of put option? So this value is a put option means we are getting some option. Okay, this is very interesting. We are getting some options. So how? Let us see. First of all, very simple. See, in my opinion, in most of this type of option, risk neutral method is generally applied because in case of valuation options, the other model is like a binomial model because we have some proportion are there for selling one call option. Of course, we are buying some delta, doing some delta hedging. But in case generally here the probability plays a very big role. So accordingly, my today's price is 150. Okay, because we are not price, we can say present value of the new proposal is considered as a present value. Now, student, I will make in the last I will draw out a table. From there, you can see that what is the present value of cash, present value of any project can be considered as a present. You can say present price. P can be considered as price. Okay. And of course, if the price goes up, so it will increase to 150. Okay, if it is the price goes down, so we will get a cash inflow of 90. Okay, these are because we are just estimating 150, but it may be turn out to be 195 or it may be turn out to be 90. Okay, now if it turns out to be 195, we will not discontinue the project. Okay, so we will not will not exercise our option. So here our option will be value, payoff will be 0. Okay, now if it turns out to be this condition, we will abandon the project. So of course we will abandon the project at 100 minus 90. So our payoff will be 10. Okay, our payoff will be 10. Now what we shall do? We shall use the probability method and a risk neutral method, and very simply, as we have applied in the earlier question, we shall say we can do that way also. Okay, or we can do that way also. Anyway, if we prefer this way, because today we are investing say some 50. Okay, and it is expected that we will gain out of a 45. Or today we are investing say 150, we are losing some amount. We can think that way also, because we are considering here the increase, 30% increase, and here the negative will be the 140. So accordingly, from this we have computed the probability of increase somewhere around 0.6857 or 6 or 68, whatever we can use. So we can compute what will be our expected payoff after 1 year. Okay, what will be a factor? So we will not, if the price goes up, we will not abandon the project. Okay, we will not abandon the project. We will continue. So our payoff, since our payoff was in this case was zero. Same here, we have used here zero. So same here, we shall use a zero. But other case was our 10. So of course, we shall consider here the 10 value. Okay, 1 minus 0.086686. So we multiply the same. So we get the value of 31 crore. Now this value will be take place after 1 year. Okay, so we have to compute the present. This option value will be after say 1 year. So we shall compute its present value. So the value of abandonment option as on date, just we use the present value factor is this one. So student, you can see all the questions are very simple. Only just we have to apply the logic. Okay, student, I hope till now you may, if you have any doubts, so you can free to ask even during the session. Now I am coming to the second last question of this today's, this is a real option. Now it says, suppose MIS is considering installation of solar electricity plant for a light of the staff quarters. The plant shall cost 250 crore and shall lead to saving of electricity expenses at current tariff of 21 lakh for forever. Forever means perpetual. Hence, however, if the government changes in the state, the rate of electricity is subject to change accordingly. The electricity will be 12 lakh. The rate can be saving of the electricity will be 30 lakh and 35. So both we can say it is lying a kind of a favorable condition, or it is kind of a sluggish conditions. Okay, similarly, and forever, assuming MIS for WACC for the MIS is 10% and risk-free rate of return is 8%. So please student note that generally risk-free rate of return are given to compute the probability. Okay, generally these rate are always given for the, only then we can use the risk neutral method. Okay, risk neutral for risk neutral method with a prerequisite is basically the risk-free rate of return. According to what we do, first we evaluate NPV for the two possible events. So as on date, at cost of capital, the value of saving forever is 2 point, very simple, 21 lakh divided by 0. It is because of perpetuity. Simple. NPV, because we are investing a sum of rupees 2.5. So our NPV is basically minus this. Now, since it is, if we see as on date, now here the role of real option comes out. If we see as on date, we will not accept the project. We say, no, it is not viable. But if we see that, if we wait, okay, if we wait, then there are two possibilities. It can be favorable or it can be against us. Now, if after 1 year, if the price of electricity increases, 3.5 crore we will get saving overall value. And of course, for this, we have to increase this. So overall, we are saving 1 crore rupees. Now, of course, if the market, we can say it is a kind of a return on our investment is equivalent to 40%, because we are investing 2.5 and we are getting a saving of perpetual value of saving is 1 crore. So now if the price of electricity goes down, the value will be 1.2 crore. And if NPV is minus, because we are investing this, so our NPV will be minus 1.3 crore. Accordingly, we can say that our negative return will be minus 52%. So accordingly, we can say that as on rate, we are investing this much. Okay, the we will gain, this will be the value, or this will be the our value. Okay, let's again we are doing probability. We are just keeping the what will be our gain or what will be our loss, and P is the probability of, again generally P is considered always a rise, favorable condition. However, we expect a return of 8% because we are considering here a return. If we solve it, we get probability of the price increase will be 0.652 and the probability of decrease will be 0.348. Now we compute what will be our expected payoff after 1 year, because generally this is used in the risk neutral method as simple logic. Here after our payoff will be 1 crore. Here it will be after 1 year this. So accordingly our expected payoff is likely to be this much. If we compute the value of present value, so it becomes 18.48. So now we can see, of course, it is advisable to wait and see. Okay, wait and watch. That's all. So we are outrightly never rejecting any project. Okay, we are not outrightly. So it is just kind of we are keeping our options open. So for this purpose, because sometimes we have to, before forming any opinion, we have to look out for a capital vesting. We have to look out for other options as well. So I hope this is clear to the student. If any query is there, please do let me know.
Sir, Abrakesh.
Please tell me, Abhikesh.
Sir, in a question, I mean, WACC 10%. Now, what is the WACC? What is the full form?
Weighted average cost of capital.
Achha, it's a weighted average. Okay. Thank you.
Yeah, because see, from the organization point of view, they have employed the capital from the various sources. Okay, so it is very important you make the difference. Okay, if in the question nothing has been only weighted average cost of capital, then even you can use also there. This is computing the risk neutral. But for the risk neutral, generally we use the risk-free rate of return.
Okay, thank you.
Yeah. Okay. Now I am coming to the very good question. It is one of my favorite questions, and it really involves practically also, because this question is basically a real example. We can say very celebrated example, a very important example from the real option point of view. So just 2 minutes, you read the question. Of course, I will recite the same. Just meanwhile, I just take a small sip of water. ABC Limited is a pharmaceutical company processing a patent of a drug called Edrix, a medicine for the AIDS patient. Being an approach drug, ABC holds the right of production of the drug and its marketing. The period of patent is 15 years, which any other company produce the drug data with the same formula. Generally, students, please note that in case of a pharmaceutical, the patent period is there. Once the patent period is over, so any other company can use the same formula and produce the drug. So ultimately, we can say that the total period for which this company gain a monopoly, any company gain a monopoly over the patent of the period. Am I right, Divas sir?
Yes, sir. Correct, sir. Correct.
Okay. So it is estimated that the company shall require to incur $12.5 million for development and marketing of the drug. As per survey conducted, the expected present value of the cash flows from the sale of drug during the period of 15 years shall be 16.7 million. Cash flow from the previous similar type of drug have been exhibited a variance of 6.8. So basically, this is variance. Basically, this is used, we can say square root of the 26.8 is our standard deviation that you need to remember. And that has been covered in portfolio management as well as many places. Okay. Now of the present value of cash flow, the current yield on treasury bond of the similar duration of 15 years is 7 points. So we can consider it as a risk-free rate of return. So student, and you have to determine the value of patent. Okay, now here we have been given some low value, some explanation value. So from this, if you see the parameters, okay, if you see the parameters, so you will see that we can use the one model that has been discussed today, because in risk neutral and binomial model, one factor is not used, that is basically standard deviation. But once the standard deviations are there, of course we have to use. Furthermore, in case of binomial and risk neutral method, there are two possibilities. One is rise, another is down. But once these possibilities are numbered, there are many possibilities. In this case, this binomial model, of course, they work, but that becomes a cumbersome. So that where we use the school of Black-Scholes model. Okay, student. So I am just drawing out a chart. From this, you will get how we can drive the. Now here, the main crux of the real option and final financial options will be more clear to you. Just 2 seconds. I just okay, student. Now here I am taking the variable. Okay, stock option, and here the real options. So for each part, you will see that pause. Now question comes, what is our underlying asset? Okay, underlying assets. Okay, spot price, or we can say not strike price. It is a kind of a support buy. So current value of stock. Here it will be the present value of expected cash flows. True. Now next we see exercise price. Next element we require exercise price. That is normally called KA. Okay. A fixed share price, generally at which the options are offered. Okay. PV of investment cost. True. Next thing, time to expiration. Okay. Generally it is fixed, like 3 months, 2 months, 1 month. Okay. Here the time is generally time until the opportunity disappears. And generally in case of a drugs and patents, as I told you, in a patent or drugs, for drugs the patent are there. So 15 year in this given case. Okay, because after this any company can produce the same using the same formula. So you know, it is only the your gain. Next is risk. Okay, stock value volatility. Okay, project value same, uncertainty. There is a one or less same. Only the difference is this. Okay, then interest rate risk, interest free risk rate or interest free rate. Sorry, my mistake. Risk free rate of interest. Corresponding to time of option. Same. Okay, here we are using the treasury bond rate of 15-year. Sorry. One second. Here we are using the treasury bond of the 15 years. That is important because we cannot use the time rate of 1 year or 2 year. It is we have to consider. Oh my God. I think all have been gone. Mhm. Okay, anyway, only last element has been left out. I'm just writing here. Okay, Nina, otherwise I have to draw the full complete table. Now last is a convenience yield. Basically, that is a dividend. Okay, generally it is case of a in a share it is considered as a dividend yield. Okay, here generally it is losing we can say losing profit to weight. Okay, student. Now I need your attention. Very important. I will just solve the back question. Then I will explain you how we use it. Okay. I'm just going back to the question. Now all the inputs are with us. Now if we see, only the one input I would like to discuss with you, and that is convenience yield. Now student, here the patent period is 15 year. Okay, patent period is 15 year. Now suppose if you wait for the 1 year, because when we while we are doing our stock valuation of a stock option, we are considering annual dividend. Okay, now if we wait for 1 year, so we are losing somewhere around this much of amount because we are losing our patent. Okay, so we can say that this is a kind of a this is kind because we are losing. If we are waiting for 1 year, so of course we are losing for 1 by 15 because our 1 year will be lapsed. Next year, if we wait for, it will become 1 by 14 because already patent period has our 1 year has been lapsed. So accordingly, with more and more time we wait, this loss become prominent. This loss become prominent. Accordingly, okay. So present value of cash flows, I'm just now using the each variable. It is 16.7 million. Okay. Now, this is my cost of development. That is my exercise price. Okay. Cost of incurring, we can say that. Cost of project. Okay. Cost of the project. And now next is percent value of investment cost. Now this is our standard variance. It is standard deviation is we will use it standard deviation. Okay. And then we come to risk-free rate of return. 7.8%. Okay. Now all inputs are with us. What we do, we know the logic of the formula. We know the formula is there. Okay. We start putting up the values. Okay. This value, this value, this value. Now, of course, this is our dividend. Okay. Now from this, we all put up, this is our standard variance. All values have been put there. And accordingly, when we compute there from table, the value of patent comes like 4.61 million. So in this question, if you say Of course, calculation can be made very easily. Only the very important that what inputs we are we are feeding in the formula, that is more important. So with this, student, I come to the topic and to the topic of real option, and of course, Divas sir has some very interesting MCQs for you. If you have any question, please you can ask.
No, sir. Clear, sir.
Okay.
Yes, sir.
Okay,
Please.
student. Now, Divas sir will share his screen and will discuss some questions, MCQs with you. Okay, thank you.
Thank you.
Okay, Divas, I am just stop sharing my screen.
Sure, sir.
Okay.
Sir, my screen is visible?
Yeah, of course, now it is visible.
Sure, sir. So, yes, students, thank you, sir, for that enlightenment on the topics, on the complex topics. So, students, we come back to our last part of the session, wherein these are some of the MCQs. So, yes, we expect all of you to answer on the query handle as well as on the Zoom, who have participated on Zoom application. So, the question number 1 is, while calculating the theoretical minimum price of a forward, return in the form of dividend is dash from the spot price. So Abrikesh has answered. I expect others also who are there on call, if they can answer. Otherwise, we will reveal the answer. So Abrikesh, you are right. It's subtracted. Any which ways, just now we also saw one of the questions that sir has solved in that dividend return in the form of dividend, we reduced it. So dividend is reduced. Question number 2. Dash is used to reduce any substantial gains loss suffered by organization by taking a position in one market against the existing position in same or other market. So what that process is called as what? Do we call it as hedging, speculation, or we call it as options, or none of the above? Abrikesh, you have answered. I think yes, you're right. That is hedging. Then let's come to question number 3. In which of the following cases payoff can be unlimited to the option parties? Call buyer, call seller, put buyer, both call buyer and put buyer. So we are talking about those payoffs that can be unlimited. It can be unlimited to which all parties? We discussed the payoffs can be by payoffs here we mean the earnings basically. So the correct answer here is D, which is for both call buyer and put buyer, the payoffs can be unlimited because there is no limit.
There was, sir, of course, the answer is fourth is option is correct. But here I have slight different view for a put buyer.
Okay.
Now say if the put buyer, suppose if I am buying a put option for say 120 strike price.
Right.
Okay, now tomorrow the price come 50. Of course, I will give 70.
70.
If price comes 0.
Limited, yeah, you're right, sir. You're right.
Something I think we will need to have correction for the same.
Got it. No, point taken, sir. Point taken.
Okay.
Then yes, we need to redraft it or we need to correct the answer as call buyer.
Generally, we can say it is a call buyer.
Yes, sir.
Okay.
Interesting. Interesting thought. Yes. Because you're right, because the potential to earn in case of a put option is limited.
Because in call buyer,
it's unlimited.
Unlimited.
It's unlimited.
Okay.
Yeah. Thank you, sir. Yes. Then question number 4, in Black-Scholes model, ND1 represents the dash of shares of stock to options necessary to maintain a fully hedged position. Yes, students, we can expect some more answers. Abrikesh and others. What does it represent? It represents, we have just discussed in today's session, ND1 is actually hedge ratio. and minus N minus D1 is actually hedge ratio of put option. So ND1 is for call option, right? Now, question number 5. Call deltas are dash and put deltas are dash, reflecting the fact that the put option price and underlying stock price are inversely related. So this also today we discussed, students. Positive and negative. Yes, Abrikesh, you are right. C part is the correct answer. Sorry. So this is the question from real option, students. Right to abandon a project at some future date at 0 or certain price is equivalent to. Just now we have covered. Ashish sir has explained the entire thing. The abandonment option gives akin to what exactly, students? Yeah, it's actually shorting the call option. Okay, good. So I think with this, sir, we end over. I mean, we cover the entire MCQs and students. With this, the derivatives topic is clear, sir. Thanks a lot for the
Okay, sir.
opportunity. Yeah.
Okay, Divas sir, thanks for spending your precious time
Thank you,
and
sir.
enlightening the student on this topic of derivative.
Thank
And
you.
we also thank the student for patience listening and interacting with us in a very responsive manner. Student, with this, we come to the end of the topic derivative analysis and valuation. In the next class, in the next class, we shall start our discussion, revisionary session on the topic of foreign exchange exposure and risk management. So student, meanwhile, before we class after some time, we'll take the next lab. So we request you to kindly go through our recorded sessions and keep ready your doubts so that the concerned faculty shall you can discuss with them. Okay, student, with this, we come to the end of this session today and have a nice day. Thank you very much.
Thank you, sir. Thank you, Divas sir. Thank you, Ashok ji.
Thank you, Ashok. Thank you. Okay, good.
Thank you.
Okay. Thank you.